Welcome to the Deep Dive. We pull out the key insights from top sources so you can get smart fast. Today, we're talking about something many people dream of: owning property in Thailand. Just imagine maybe a beautiful villa overlooking the sea in Phuket, and just a quick note, that's pronounced Phuket, not Phuket, or maybe a gorgeous place right on the beach in Koh Samui. That's a fantastic dream, right? But like any big investment, especially overseas, there are some financial details you really need to get your head around. So our deep dive today is built around a great article called Thai Property Taxes for Expats. Avoid these surprises. And this isn't just some random blog post. It comes straight from Ocean Worldwide. They're a top-tier luxury real estate agency, and they've been right there on the ground in Phuket since way back in 2004. Yeah, they really focus on that high-end residential market in Phuket and Koh Samui. And the agency director, Sandra O'Neill, she's personally helped like thousands of families and investors figure this stuff out over the years. So our mission today is to pull out the absolute must-know numbers and timelines from their expertise, basically to help you understand the fees and taxes up front, so you don't hit any of those nasty surprises later. Okay, let's unpack this then. What are the essential financial bits an expat or investor really needs to grasp right at the start when they're just looking at property in Thailand?
Well, the first thing that jumps out from the source is, while the whole system might seem a bit complex at first glance, these initial buying costs, they usually add up to roughly 5 to 7% of the property's value. And here's the interesting part. They aren't always set in stone. Often, they're actually negotiable between the buyer and the seller.
Okay, negotiable. That's really good to know. Because, yeah, I imagine a lot of people just focus on the sticker price and forget about these other upfront costs. What's the biggest slip up you see when people don't factor these in properly?
The biggest issue is just not budgeting enough, frankly. People often miss the first major cost, the registration fee.
Yeah.
This is standard. It's paid to the land department when the ownership officially transfers, so usually 2%, and this is important, it's 2% of the assessed property value.
Ah, the assessed value, also called the cadastral value, right? Not necessarily what you actually paid for it.
Exactly. So, for example, if the government assesses a place at, say, 5 million baht, that fee is 100,000 baht, even if you bought it for more or less. And traditionally, that 2% is split 50-50, 1% buyer, 1% seller. But like we said, it is negotiable. It's all down to what's agreed in the contract.
Right, check the contract. That difference between assessed value and sale price seems crucial for budgeting. Now, specifically for expats, are there different ownership rules that affect these initial steps?
Oh, absolutely. And this is a really vital distinction. The rules for foreigners owning property, they change quite a bit depending on the type of property. Understanding this is key for, your rights, your taxes, everything down the line. Generally, foreigners can own condominiums outright, freehold. But there's a limit. Foreign ownership can't exceed 49% of the total unit space in that building.
Okay, so condos are possible up to that 49% limit. What about land or houses?
That's where it's different. Direct ownership of land, and therefore houses built on it, usually isn't an option for expats. So the common ways around this are long-term leasehold agreements, often starting at 30 years, or setting up a Thai company specifically to own the land.
Leasehold or via a company.
Yes. And it's so important to get legal advice to clarify the exact ownership structure before you sign anything. It really impacts everything else.
So it's not just about budgeting extra for fees. You absolutely need to know from day one how you'll own it, whether it's that luxury condo or, say, a nice villa near Bang Tao Beach in Phuket. It sets the whole stage financially.
Okay, let's shift gears a bit. What about when you decide to sell your Thai property? You mentioned timing earlier. How long you've owned it affect things?
Right, selling. Looking at the bigger picture here, that 5-year ownership mark, it's incredibly important for sellers in Thailand. It's a detail that can really change your tax situation quite dramatically. You definitely don't want to miss that. 5 years. Okay. How exactly does hitting that 5-year point, or not hitting it, change the taxes when you sell? What are the main taxes we're talking about here?
The big one is called the Specific Business Tax, or SBT. It's set at 3.3%, and that rate actually includes a little bit of municipal tax, too. Generally, this SBT applies if you sell a property within 5 years of buying it. It also applies if a company, a legal entity, sells a property regardless of how long they've owned it.
Okay, 3.3% within 5 years, or for companies. How is that calculated on the sale price?
It's calculated on whichever is higher, the actual selling price, or the official cadastral value, that government assessed value we talked about.
Ah, the higher of the two again.
Yep. So say you sell for 10 million baht, but the cadastral value is only 8 million. The FBT is based on the 10 million, so that'd be 330,000 baht.
That 3.3% could definitely take a bite out of profits, especially on a shorter term hold. Is there any way around the SBT for individuals selling within 5 years?
There is a very important exemption, yes. For individuals, if the property was your primary residence, your main home, and your name has been officially in the house registration book, the Tadian Bayan, for at least 1 year from the date you bought it, then the SBT is usually waived.
Okay, that's huge. So living there as your main home for at least a year gets you out of SBT, even if you sell before 5 years.
Correct. That primary residence rule is a key one. But if it's, say, a holiday home or purely an investment property you're flipping quickly and you haven't lived there officially for that year, then yeah, you'd likely face that 3.3% SBT if sold within the 5 years. You'd need to factor that into your calculations.
Makes sense. So if the SBT is waived either because you owned it over 5 years or you qualify for the primary residence exemption, what tax applies instead?
Then you usually pay stamp duty. That's much lower, only 0.5% of the registered value.
Or 5%.
Yeah. And the key thing is, it's usually one or the other. You pay SBT or you pay stamp duty, not typically both.
Okay. SBT or stamp duty, got
Yeah.
it. Any other taxes when selling?
There's also withholding tax. This basically acts like an income tax prepayment for the seller. The calculation gets a bit complicated. It depends on the property value and how long you owned it. Honestly, the tax system for selling, it can feel like a bit of a maze. Getting some professional advice, maybe from a good lawyer or tax advisor, is usually a very good shout just to get an accurate picture of all the costs involved. Avoid those surprises.
I can definitely see why. Are there any, online tools someone could use to get a rough estimate? Maybe if they're thinking about selling that villa in Samui or a penthouse in Patong, Phuket?
Okay. Oh, yeah, definitely. There are online Thai property tax calculators out there. You can usually plug in the sale price, the assessed value when you bought it, and it'll give you a pretty decent estimate of the total tax hit. They can be super helpful for planning.
That's useful. So it really sounds like whether you're aiming for a quick flip or you're in it for the long haul, that 5 year mark and understanding the primary residence rule are just absolutely critical for planning your investment and eventually your exit strategy in Thailand. All right, so we've covered buying and selling. What about just owning the property, like year after you've bought it? Are there ongoing taxes you need to worry about?
This is actually one of the really attractive things about Thai property for many expats and investors. And it's quite fascinating compared to other places. Generally speaking, Thailand does not charge an annual income tax just for owning residential property.
Really? No yearly tax bill just for having the house or condo?
Largely, no. It's a significant plus point. You won't get hit with an annual wealth tax or property tax simply for possessing your home or your holiday place there. That's quite different from, the US, UK, many other countries.
Wow, that's definitely a big draw for investors, I'd imagine. So mostly zero annual tax on residential property. Are there any exceptions at all? Any small print?
There's one main caveat, yeah. It applies if you own undeveloped land. So just a plot of land with no buildings or major structures on it. In that case, you might have to pay a small annual land tax. The rate is usually pretty low, around 0.1% of the land's assessed value.
Okay, 0.1% on empty land. Why do they do that?
The idea behind it is really to encourage development, to stop people just sitting on empty land indefinitely without using it.
Got it. Okay, so minimal ongoing tax unless it's undeveloped land. But what if you decide to rent your property out? Does that change the tax picture?
Ah, yes, renting. That definitely changes things. If you rent out your Thai property, any income you get from that rent is considered taxable income in Thailand. No question about that.
Okay. Rental income is taxed. How does that work?
You'll need to declare that rental income officially, and you'll pay income tax on it based on Thailand's standard progressive rates. Basically, the more rental income you earn, the higher the tax rate you'll pay on it. And because of that, it's really, really important to keep good, clear records. Keep track of all your rental income, but also any legitimate expenses you can deduct against it, like maybe management fees or certain repairs. That can lower your taxable income significantly.
Right. Good record keeping is key for rentals. Now, going back to selling for a moment, we talked about withholding tax. But what about the actual profit you make, the capital gain? How is that taxed?
Okay, capital gains. When you eventually sell your property in Thailand, any profit you make, the difference between what you bought it for and what you sell it for, basically is generally treated as just regular income for that year.
So it's not a separate capital gains tax rate.
Not exactly like in some countries, no. That profit gets added to any other income you earned in Thailand that year, maybe from salary or business or those rentals we just talked about. And the total amount is then taxed according to Thailand's standard personal income tax, or PIT, rates.
And those PIT rates, they can go up quite high, right?
They can, yeah. The top rate is currently 35%. But, and this is a really crucial part about, there's a system of deductions that significantly reduces the taxable gain, especially if you've owned the property for a while.
Yeah.
The longer you've owned the property, the larger the percentage of the cadastral value you can deduct before you even calculate the taxable gain.
Ah, okay. So holding on to the property longer directly reduces the tax you pay on the profit. Can you give some idea of how those deductions work?
Sure. It's based on years of ownership.
Mm.
Here's a quick rundown of the percentage of the cadastral value you can deduct. If you've owned it for 1 year, you deduct 92%. For 2 years, it's 84%. 3 years, 77%. 4 years, 71%. 5 years, 65%. 6 years, 60%. 7 years, 55%. And if you've owned it for 8 years or more, you get to deduct 50%.
Wow, that's quite a scale. So owning for 8 years lets you cut the taxable base related to the cadastral value in half, essentially.
Exactly. This table really shows how being patient and holding the property long-term can seriously reduce your overall tax liability when you sell. It's a clear incentive, showing that a longer hold often pays off from a tax perspective.
That's a very strong incentive for thinking long term. Any other good news on the capital gains front for investors?
Yeah, just a small related point.
Yeah.
If you happen to invest in the stock market there, any profits you make from selling shares or other securities listed on the Stock Exchange of Thailand, those are typically exempt from capital gains tax.
Okay, good to know for broader investments. So wrapping up this section. Huge plus is no annual property tax just for owning, but definitely be ready to pay tax on rental income and on your sale profits, although that profit tax can be significantly reduced by holding the property longer thanks to those deductions. All right, now let's talk about avoiding the hidden reefs, the common pitfalls. This feels really important. Buying property in Thailand sounds amazing, but it seems like it could be easy to trip up if you're not careful. What are some common traps people should watch out for?
Yeah, thinking strategically, it's true that many people do get caught out by things they just didn't expect, and that can quickly sour the whole dream, turn it into a real headache. Probably the most fundamental pitfall is simply not understanding the ownership laws properly. We touched on this, but it bears repeating. Foreigners generally cannot just buy land outright. For condos, you've got that 49% foreign quota limit. For land and houses, it's usually going to be that long-term leasehold or setting up a Thai company. Getting this wrong from the start, that can lead to massive problems down the road.
Right, that ownership structure is foundational. What else?
Another big one is skipping proper legal due diligence, or maybe trying to skimp on it. It is absolutely essential to hire a qualified, independent lawyer. They need to thoroughly check the title deed. Are there any outstanding loans against it? Any legal disputes? Are there liens or encumbrances? They also need to check that the property actually complies with local building codes and zoning rules.
You really don't want to find out later that something wasn't built legally.
Exactly. Imagine you're investing in a serious property, maybe like that example in the source.
Yeah.
A 3-bed, 4-bath place in Phuket going for 43 million baht. You absolutely need to know all the permits are correct and the title is clean. Skipping due diligence is just asking for trouble.
Okay, ownership laws, due diligence. What's next?
Ignoring the hidden costs. We talked about the 5-7% upfront, but it's easy to forget. The price you see advertised, it's almost never the final amount you'll pay. You have to budget for those extras. Registration fees, stamp duty or SBT, legal fees, and then don't forget the ongoing costs. Potential renovations, furniture, insurance, property management fees if you rent it out, general maintenance. Thinking about, say, a beautiful Japanese-style villa in Bang Tao, Phuket. You need the full picture of the total outlay, not just the asking price.
That total cost of ownership is key. Any other common mistakes?
Yeah, a couple more. Not doing enough location research. Really dig into the neighborhood. What are the amenities like? What's the traffic? Are there any big construction projects planned nearby that could affect noise levels or your view, or maybe even property values? And finally, probably the most common human error, rushing the decision. Buying property anywhere is a huge financial step. In a foreign country, even more so. Don't feel pressured. Take your time, compare different properties, listen to your advisors, be patient.
That all sounds like very solid advice. It really underlines the need for good guidance. Just how critical is getting professional help when navigating this market?
Honestly, trying to do this all alone, navigating Thai property law and the tax system, it's kind of like trying to assemble complicated flat-pack furniture, without the instruction manual. You might eventually get something built, but chances are it'll be frustrating, take way longer, and you might end up with some expensive leftover parts or a wobbly result. A good lawyer who really knows Thai property law isn't just a nice to have. It's a smart, necessary investment.
What exactly will a good lawyer do for you in this process?
They'll explain those tricky ownership structures, clearly freehold for condos versus leasehold for land, and the company option. They'll advise on the best way to structure your specific purchase to be tax efficient. They'll handle that crucial due diligence, verifying the title, checking for problems, making sure everything's compliant, and they'll meticulously review and help negotiate the purchase contract to make sure the terms are fair and your interests are protected.
And I guess that's exactly where agencies like Ocean Worldwide come in, right? Being specialists in luxury property, based right there in Phuket since 2004, that local expertise must be invaluable.
Absolutely. Their deep understanding of the Phuket and Koh Samui markets, combined with years of experience like Sandra O'Neill and her team have. That's precisely what helps clients navigate these complexities smoothly. They bridge that gap, help avoid the pitfalls, and turn what could be a stressful process into a successful investment.
So the big takeaway here, professional advice isn't just a suggestion. It seems like it's practically essential to make your Thai property dream happen without any of those nasty, costly surprises later on. Well, there you have it.
That was a pretty thorough deep dive into Thai property taxes and costs for expats. We've certainly unpacked a lot today, from those initial buying costs and ownership rules right through to ongoing taxes and what happens when you sell.
Yeah, and putting it all into context, what's really clear is that Thailand doesn't have some special foreign buyer tax designed to single you out. It's more about understanding these standard taxes and fees that apply to everyone and figuring out how they apply to your specific situation, your property type, how you own it, how long you hold it. Being prepared, doing your homework, getting good advice. That's really the key to making it work smoothly.
Absolutely. So just to quickly recap the absolute must-knows for you, the listener. Expect those initial transaction costs to be around 5 and 7%, covering things like registration fees. And remember, these can often be negotiated. When selling, that 5-year ownership mark is crucial. As is the primary residence exemption, they determine whether you pay the 3.3% specific business tax or the 0.5% stamp duty, a huge plus. Generally, no annual tax, just for owning residential property. But definitely expect to pay tax on any rental income and on the profit when you eventually sell, though long-term owners get significant deductions on that profit. And remember the ownership basics. Foreigners can generally own condos outright within that 49% limit, but for land and houses, it's typically long-term leasehold or via a Thai company structure. And maybe the biggest point, the absolute necessity of thorough legal due diligence and getting expert professional guidance. And remember, all this great insight came courtesy of the experts at Ocean Worldwide, the luxury real estate specialists in Phuket and Koh Samui. With folks like their director, Sandra O'Neill, guiding investors since 2004, they've certainly got the experience to help make those property dreams a reality.
So here's something to think about, connecting all these pieces. We've seen there are clear tax benefits for owning longer, no annual tax burden on your home, but also the absolute need for good advice and understanding ownership rules. Given all that, what does it really mean for crafting the best long-term investment strategy in a dynamic, high-end market like Phuket or Koh Samui, especially when you're weighing up, say, a condo versus a villa or thinking about your eventual exit plan? How do these tax nuances shape that long-term game?
Definitely something interesting to mull over as you maybe plan your own venture into Thai luxury real estate. Thanks so much for joining us for this deep dive. Until next time, keep exploring, keep learning, and stay well informed.